Welcome to the XY Advisor Podcast, a global community of financial advisors sharing and learning with one another to drive the positive evolution of financial advice. To get involved, go to xyadvisor.com or simply download the XY Advisor app.
Innova Asset Management is a boutique portfolio manager that has been managing client portfolios since 2010. Innova believe in constructing portfolios that work with investor behaviour rather than against it. This is why they have built risk-focused portfolio solutions that support a goals-based advice framework. Innova's focus on risk management and their active approach to asset allocation has been designed to work through all market cycles, which was evident in 2020 when they were able to participate in the market rebound while also protecting capital on the downside.
Hello and welcome to this topic series on behavioural investing, where we're taking a deep dive into the client and advisor decision-making process. My name is Fraser Jack, and in this, the final episode rounding out the series, we take on not so modern portfolio theory, where we discuss the Traditional Strategic Asset Allocation, or SAA, and how it compares with dynamic or risk-defined portfolios and what that means to your clients. If investment advice is part of your value proposition, then this episode is for you. Thank you for joining us again. This is episode 5 in our 5-part series. We are talking about modern portfolio theory. Now, this is a classic. I might start with you, Catherine. The research show, maybe nearly 70 years ago, we had this thing, and it evolved over time. Modern portfolio theory. It came in. It seemed like a great term at the time, but these days it doesn't sound like it's the term we should be referring to it as anymore. What are your thoughts?
These days, it's definitely all been thrown out the window. I read a blog post the other day that was titled, "Nothing is real anymore." And it had all of just the basic fundamentals all mapped against each other. And it does make you wonder what's going on, especially from a macro, larger perspective. So the modern portfolio theory it still has some basic relevance, I think, in terms of just risk and return, in general, that kind of basic overlay potentially still has some relevance. If we look at, say, a new cryptocurrency, yep, all the risk in the world and potentially all the return in the world. Great. Excellent. That's easy. But for traditional asset classes, this is an absolute nightmare. We always knew that cash was a very risky asset class for young people, because if we define risk as the chance that you will not achieve your goals, then obviously investing in cash is one way to almost guarantee that young people won't achieve their goals, because it'll be eroded by inflation and tax. And they'll be going negative. Hard to achieve goals when you're going negative. But these days, with interest rates where they are, etc., it's that discussion, but on steroids, and now for everyone, not just for young people.
Yeah. Now, I think one of the things that we're guilty of in some of the past advice and the evolution around financial advice is that we've sort of hung our hat on this. It's been easy just to stick with modern portfolio theory to understand there's defensive and growth assets, and there's an arc, and it all works like this, and it's probably going to come back to. Patricia, I really love what you said in one of the previous episodes around we were talking about tools and today's world and today's advice is very different, because we've never had what we have today. What are your thoughts around this, and how do we bring this investment conversation to around modern portfolio up and to describe it with clients and in a way where we might have other things to look at, other asset classes and other conversations to be had, but it's just very difficult to make it fit within the traditional boxes of financial advice?
Yeah, I think there's a lot of complexity here, to be honest. I think it's a little bit of a Pandora's box. What we were saying in the previous episode about what we consider defensive, not being so defensive anymore with bonds, for example. But then what do we use instead? So it is actually quite a difficult period that we're living in. We've never experienced anything like this before. So it makes it really difficult, obviously, for investment managers, and let alone for compliance and to catch up and licensees and what's acceptable, for us to recommend retail clients. So I think it requires, there's a lot that we need to be looking at, more and more we're seeing some solutions to that. So, for example, allowing portfolios to have a higher range of tactical allocation, so that, maybe back in the day where there would have been only a 10% tolerance, you can see more of a 30% tolerance these days. Again, very complex. And I think this is why we need, different layers of professional expertise. That's why I believe that my job is not to be an investment advisor, as in we're not there picking stocks or bonds or determining asset allocation on a daily basis. We're there talking to clients, right? So, and then you've got other investment managers and experts that you lean on, and different product solutions that, as time goes by, we're seeing different products come to the market that have different approaches and they can address different issues, I guess. So I think we just need to continue to evolve there with the solutions that the product providers are giving us to address the complexities of investing these days.
Yep. Now, Catherine, I wanted to ask you about something that you mentioned in the previous episode regarding, with risk profiling and the complaints that have come out of this area with people saying, I didn't know, and I was put into this thing, and it's not as per my risk profile, and then the relationship with risk profiling tools. They might have been out of date or whatever, but then being such a growth defensive basis and having to stick within those types of realms, especially when interest rates are so low.
It's a nightmare scenario, it really is. And it's been built off the back of, I think, 30 years of quite high, unrealistic expectations of returns. So I'm not sure when it was, but it definitely was a time when the balanced portfolio was 50% growth assets and 50% conservative assets. I'm sure there was a time. I don't remember it, but I'm sure it exists. But ever since, for the last 20 years or so, might be a bit extreme, but a balanced portfolio is now 70%, often 70% growth and 30% defensive. And that includes in the industry funds who are, in theory, there for their members. And so not only is that kind of asset allocation an issue, potentially, in the current climate, but also the classification of what is a defensive or conservative asset. So if you've got cash returning 0 with inflation at 7% or 5%, it doesn't really plus, well, there's not much tax on 0, I suppose. But that is, how can that be ever classified? How can a guaranteed negative 5% return be classified as a conservative asset? If anyone said, you invest in this thing, we'll guarantee that you lose 5% every year, people would say, well, that sounds terrible. So there's even just the classification of how we think about each of these asset classes is a whole different discussion. And I think that plays in with shares in particular, Australian and international equities, with the overvaluation scenario that we're in. It really makes you think, are they aggressive assets or are they gambling at this point? Like, how do we classify each of these asset classes on a regular basis? And it's not, like you mentioned, Patricia, it's not really our job as a financial advisor to every day be looking and calculating and trying to figure this out. There are people who it is their job, and it's our job to work with clients. So it's a complicated scenario when you overlay that with the importance of risk profiling and how the risk profile in theory leads directly to the asset allocation, which leads directly to the returns regardless of crash or not. So it's almost like a perfect storm. It's
a good point that you made there, Catherine. One of our biggest bugbears is the way that the defensive assets are categorized how there is no consistency, or how someone can call a balanced portfolio and it's a 50-50, or I've seen balanced portfolios, Catherine, that are like 88% growth. Or, how is that allowed? One of my biggest bugbears is there needs to be consistency between what's defensive, what's growth, the names that we give them, so that clients aren't misled. There's plenty of clients in what they think is a balanced portfolio. Balance, as the name suggests, should be 50-50. Well, it's not. I think, we definitely need to address that, and that requires the government to step in as well.
Yeah, I couldn't agree more, Patricia, on the naming conventions around, what are these things? All we're asking for is consistency across the board, so it's easy to compare apples with apples. But then if we also throw in, dynamic asset strategy, tactical, then you've got, risk defined and total assets. There's all these other categories that are now sneaking in to conversations. Does that just confuse the matter for clients?
How long's a piece of string? I think, for example, do we really go into a 2-hour webinar with clients about what bonds are and the different credit securities? Of course not, right? So they need to know enough, but how technical you're going to be. It's important to also make sure you don't confuse them. So I think that, again, I agree with Catherine's comment. Our job that's not our job. The onus of that should be put back on product providers in how they classify their products, what the risks they are in that moment. Exactly, like it's cash risky today, and essentially relying on them to build those products and have the right labels, and for us to then build the right portfolios with the right labels, not for us to always think of cash as defensive, for example, regardless of what the interest rates are and inflation. So I think, again, a bit of a Pandora's box, but definitely a lot of work there still needs to be done with the product solutions that we have.
Yeah, and Catherine, obviously, I feel like it's a great idea that advisors have an investment philosophy, whether it's, we're not investment managers, we're advisors, or whether it's we want to do this or we want to do that, whatever that might be, for that to be clearly displayed on the label, on their website, in their passion, in their enthusiasm before clients come in, and then clients can either buy into that concept as one of their values or not one of their values, and they can detract from being a client of that advisor. Is that a solution for for advisors to be able to say, this is where I hang my hat, this is my belief, this is my passion, this is my values, this is my thoughts on the subject, and this is where, and if I do that on the label, then we're not really talking about so much around that I should have done this other thing for the client, but I never do that. And going back to your comments before around, a lot of advisors have that bias anyway.
Mm-hmm. So we know that it doesn't matter what field you're in, but the best success is probably going to come from a specific niche. So you're going to be not trying to be everything to everyone, probably. You're going to be marketing towards a specific niche. And I think that builds on the discussion we had earlier about really being transparent and upfront about what your niche might be. And your niche might be, like I talk about myself, I started at the end of 2007. Great timing. So I'm very much focused on strategies, and I am overly conservative when it comes to clients' money. And that is who I am. And I don't think that it's my job to get up in the morning and check the US markets, really. If it comes across my feed, fine, but that's not my job. And I think, so I'm not an advisor anymore, but if I was an advisor now, I would imagine that the kind of positioning that you can acquire by being transparent about what your role is. So not necessarily in how I communicated to them what I don't do, but in terms of what you do in a positive sense. I think it can be so empowering. There's so many really successful stockbrokers, and they tell their clients, this is what I do. I pick stocks. That's all I do. Don't talk to me about your insurances. I don't care. You don't have an estate plan? Not my problem. Don't talk to me about it. It's not my specialty. Like, my specialty is I'm going to pick some stocks for you, give me some money, and I'm going to pick the best stocks for you and get you a return that's associated with your risk tolerance. So they're very upfront about what their niche is and what they can deliver to clients. And I think we can lose our way as holistic advisors when we start to think that not only do we really spend a lot of time getting the clients to articulate their goals and their values, and we quantify achieving them, we set them up with a plan, we check in with them. Oh, and also we manage every single dollar down to the T in an environment where, as you mentioned before, Patricia, cash and bonds are no longer really quantitatively defensive assets.
Yeah, definitely. I can't wait until technology can help us with that a lot more for simpler things, to be honest. Like, for example, if I have a client doing a regular withdrawal and we're doing it because markets are high, they don't necessarily need it. We're paying down debt. It shouldn't be my job to try to remember that I have that client that when the markets crash, that I have to stop the regular withdrawal, things like that proactivity. So I think there's a lot of tools that technology should be able to help us with to be proactive and not just reactive, and have flags of things that we should be doing from a time critical perspective. But yeah, it is not my job to try to remember. And I say that to clients. I even say, with clients that we're regularly contributing or withdrawing, I say, I'm not going to remember. We don't have a list of clients and we call them every day about what markets are doing and we're going to stop or we'll start. That's not our job. Hopefully one day technology can help us with that, but at the moment it's not our job. But remember our discussions, and if you want to stop it and if something happens, come back to me and we'll do it. But I wish I could be more proactive in that sense. I think that there's some work being done there, but I'd love, technology to help us with that. So our job is to remember, know what the clients want, have flags and triggers to help them with the behaviors along the way. It's not about what markets are doing as such.
Yeah, fantastic. And I love that concept, that both those concepts, but the one about transparency being an opportunity. This is what I do. This is how I operate. This is what I do best, and leaning in towards that. And Patricia, just, with yours, you're, as you've mentioned many times throughout this, you definitely help the client with goals under management. You're making their goals and dreams and aspirations come true. You're relating money back to them. You're not there as a fund manager, and leaning into that concept and explaining that to your clients. Thank you so much, both of you, for coming on and chatting in the whole series. I really appreciate it. We often give the listeners an opportunity, if they want to continue the conversation, what's the best way of reaching out to you and continuing the conversation. Patricia, if somebody wanted to reach out to you, what's the best way they can find you?
If they just try to find me on Instagram or Facebook, Patricia Garcia. It shouldn't be too hard. I think my Instagram is Patricia Garcia Advisor, so it's pretty easy to find. And then our website is yourvisionfinancial.com.au.
Fantastic. I love the fact that you're on Instagram, not just, the LinkedIn, the standard LinkedIn area, which is more where I play. Catherine, if somebody wants to reach out. Yeah. If someone wants to reach out to you, Catherine, what's the best way they can find you?
Yeah, I'm not as much a Instagram icon as Patricia, so probably just a message on LinkedIn would be easiest for me.
Yep, fantastic. And Catherine, you're also working on a lot of stuff around the ethics, in the ethics space and in the ethics training space. So I look forward to seeing more of that come out over time. Thank you so much. Really appreciate your help with these episodes. Welcome back, gentlemen, to this conversation. We are covering off on the concept of modern portfolio theory, in particular things like SAA or risk-defined portfolios. We're getting a little bit deeper into this conversation now, where we're starting to look at, the investment world of the past versus the investment world of the future. Let's go with Dan. Dan, you want to kick off on this one? What are your thoughts?
David, I know, has got a quote and believes that Harry Markowitz gets blamed for a lot unfairly, and I completely agree with him. And I've published a few articles on this, in that there was a huge misinterpretation of what his seminal paper back in 1954 said, which was that the use of diversification, the use of assets that have less than perfect correlation combined together, can lead to a result that is either the same level of return for lower risk or a higher level of return for the same level of risk. But at the end of the day, it was about risk management. That's what it was about. It was about risk management. He actually said in the paper, this is based on historical data, and when you look at the optimal risky portfolio sitting on the efficient frontier, it came out at a 60-40 US equities and bonds solution. And then the industry took it and turned it into the 60-40 portfolio that became prevalent throughout the world. It wasn't Harry Markowitz who did it, and yet people blame him for it, and yet he never said that in his work at all. The thing that I like to point out, and one of the core principles of Inova is that the concept of robust rather than optimal portfolios. I had a conversation with a very intelligent ex-employee of mine who's CFA qualified, and I talked about this concept of building portfolios based on risk benchmarks, not on capital market benchmarks, but on risk benchmarks, because it's risk that can cause clients to have negative behavioural responses that can be value destructive and can derail the entire advice process, which is far more than just investing. And he said to me, yeah, but Dan, if you're going to be using mental accounting and bucketing and you're going to be combining portfolios for different goals, you're not going to end up with an optimal portfolio. And I said to this gentleman, yeah, but there's no such thing as an optimal portfolio. And I never refer to any of the modeling that we have as an optimizer because it can only optimize to the inputs. And yet the inputs, we know that they will not be exactly how things pan out in the future. They aren't. They can't. So we think that the concept of robustness is about, we deal in a world of probabilities, and we can use advanced statistical measures to apply probabilities to outcomes to build more robust solutions that can be distilled down into some fairly simple messages. If the potential upside on an asset or a series of assets is really, really high, and you have a really high level of confidence in them, you may want to concentrate a lot more of your portfolio in those. But if you're in a period of time, such as now, where uncertainty is really high, and yet the potential returns are very low because, valuations are high, yields essentially don't exist, you may want to be far more diversified. That's not rocket science. You can apply things like the Kelly criterion and other very advanced statistical measures to do it, but they do boil down to some fairly simple concepts, which I think can lead to more robust portfolio construction. And I think building them based on risk budgets you want to maximize the level of return within those risk parameters, but benchmarking yourself to risk goes a long way to managing that client behavioural element that we started this whole conversation about in terms of goals-based investing, goals-based advice.
Yeah, Dan, you've got some big themes to unpack there, and I might just start with a short story arc on just modern portfolio theory, because I think where we want to get to is really asking ourselves, is this SAA approach the right way forward for the advice community? So I'm glad you're sort of defending poor old Harry a little bit. So the modern portfolio theory guys, I'd sort of say there's Harry Markowitz, James Tobin and Bill Sharp. They're all Nobel Prize winners, and between them all, and sort of over a period of nearly 15 years, they came up with this sort of framework. So you're spot on, Dan, that really what Markowitz said is try and there's a framework here for maximising return for a given level of risk. And that makes sense. And then between Tobin and Sharp, they sort of said, well, if you identify this optimal portfolio, then you can use that in conjunction with cash or in conjunction with leverage. And in a way, everyone should have that same portfolio and leverage it up. And those two things combined are pretty much modern portfolio theory. What it doesn't consider, and they're pretty all open and honest about this, and that's the thing, academic research always is very narrow in a specific area with lots of exceptions put to the side because they just want to explore a particular arc. So Dan's point about inputs is just spot on. So garbage in, garbage out. The efficacy of using that framework comes down to how well how the quality of your inputs are. It doesn't account for transaction costs. It assumes normal returns. But even with those three things, you can probably still manipulate the framework and use it well. And then you get things like difference in the liquidity of different investment opportunities. So think about private market assets. Now it's starting to get a lot more complex. And then you've got term effects. So that whole framework's just a single period framework. Some people are making a 1 month decision, others are making a 20-year decision. So that starts to get really messy. And then finally, you've got you've used the word intertemporal a few times, Dan. I love that word, but I've tried not to use it along with stochastic. But now that you've sucked me in, there's sort of this intertemporal decision making and what that means is that you're going to be updating your decisions through time. Each period of time, you're going to reassess what's on offer, the opportunities in the market. Should be reassessing your goals as well. You reassess your plan and you put it in place. And that really steps outside this framework. Once you do that, it's really stepping fully outside that framework. So that's sort of the journey of modern portfolio theory. And then somehow, advice industry, I think particularly in the US, grabbed that and sort of said a 60-40 portfolio works really well. And to be honest, for the last 30 years, I saw some research the other day that sort of shows it still has outperformed a lot of financial plans. The question now is whether we can't all just adopt the behavioural bias of anchoring ourselves to something that might have worked for the last 30 years. What is the right approach moving forward?
Yeah, that's a really interesting point for both what you mentioned there, but also what Dan was saying before about optimal portfolios. It's very easy to find the most optimal portfolio if you're looking backwards, isn't it?
Yes, that's right.
You can certainly find out that which could have been better at the time. Just in that, then, if that's not necessarily the right answer moving forward, what can we start doing and what can we start looking at, Dan?
Well, I think to begin with, the question of whether the SAA portfolio will it be appropriate going forward, we will only know with the benefit of hindsight. But if we just think of some fairly simple things that have, you mentioned 30 years, I'd say 40 years. I'd say since 1981, you've had this period of, high starting yields on bonds, low valuations on equities. You've had expansion. You've had both predominantly monetary looseness that has allowed a tailwind in the majority of asset classes. And we are at a point now that, I find it very hard to see how that 40-year tailwind can persist for, an extended period of time. And so I think a solution going forward is more about being a lot more dynamic. If you talk to an advisor and to their end client about, what's in their portfolio, the client doesn't care if you're sticking to an SAA or not. All they want is the outcome. They don't care. What they want is for you to give them what it says on the box. And so I think that's where some solutions should be based around this concept of trying to build robust ability in the face of uncertainty using, statistical probabilistic methods to try and say, okay, well, we don't know what the future is, but we can probability weight based on the evidence that's available. In hindsight, it probably won't be the best solution, but at least we can stack the deck in our favour so that we're going to be more likely to end up getting a better result. And on top of that, that we haven't gone and done something in terms of the risk associated with the portfolio that blows up the whole behavioural concept that the client has gone through, which is why I founded my firm, and which is why we push this concept of portfolios built around risk benchmarks, because they allow for robustness, they allow for managing to risk irrespective of the environment. Like if we have another 40-year tailwind, okay, fine. But if we don't, okay, that's fine too. It actually doesn't matter. It's because you're managing it to that risk amount that you're trying your best not to breach, because that's what's going to cause the behavior response from the client that could completely derail the entire advice strategy. And then everything's gone out the window.
Yeah, Dan, when you say robust, you've mentioned a few times it's a really interesting concept. Are you talking more around the risk side of that, or we're talking value type stock? Like how would you simplify that term?
I'd simplify that in robust as in under varying stress scenarios that outcomes are within bands of reasonableness based on what a client has defined that they can tolerate. Whether they are historical tests or they are forward-looking theoretical stochastic tests. So, like a Monte Carlo simulation of a series of events based on inputs. And you can invent things that could go wrong, and how that could potentially affect the portfolio, and building portfolios that are robust under different environments. You've got the Bridgewater cross where they talk about economic growth and then inflation, and they talk about their 4 quadrants. We talk about 6 kind of blocks. A portfolio that is going to be reasonably robust in each of those 6, but probability weighting the fact that you don't know the future perfectly. So don't have all your eggs in one of those baskets. Risk weight the allocation and tilt towards the one that the evidence is telling you is the most likely to occur. And as the information changes, be prepared to change, which comes back to that systematic approach that I referred to earlier. And having some hedges in place in case you're wrong, because you invariably will get stuff wrong.
Yeah, it's. I agree with that framing of robust approaches to portfolio and how you've described it, Dan. And I do think it's a great approach. And I just probably throw in an observation there that there's a unique opportunity for advisors to do that compared to the superannuation industry, because the superannuation industry has a lot more peer group pervasiveness about it, and robust portfolio approaches sort of mean that you may not participate fully in the most upside scenario, because you're spreading, you're sort of taking decisions to ensure that you do well in other scenarios as well, or do acceptably well. And so there's a little bit of a give up there. You translate that to a peer grouped industry, and you've nearly got to pick which scenario is going to be the one that most likely evolves and play for that, so you don't underperform your peers. And so there's a great opportunity for advisors to add, at a system level, huge value to their clients by adopting approaches like what Dan's described.
Yeah, it sounded like we missed out on having that conversation in the first episode when we talked about biases, that peer group conversation.
Yeah, well, it dominated my life for a while. So I'm happy to miss that one.
There's a lot of comparison, isn't there, about top quartile or top percentage or whatever it might be.
So so Dan did touch about the time frame of your process. I think that's important. You're sort of seeing this evolution of SAA with like a dynamic asset allocation approach overlay. And then you sort of just say, well, actually, I'm just going to be fully DAA might be an extension to that. And then what we're seeing in the institutional world is sort of the emergence of this jargon called total portfolio management approach, or the total portfolio approach, is sort of where you're no longer having sort of silos across your portfolios. And you're just saying, well, here's my current portfolio. I'm constantly going to be trying to take that portfolio on a risk-return adjusted basis, or a robust, whatever sort of philosophy I use, into a better place, and becomes a whole of team effort, which obviously has cultural challenges to it. But that's sort of where the institutions are heading, down that TAA approach. What I always find interesting with the DAA type approach is as you get shorter and shorter, personally, I find it harder and harder to have really quality insights into markets. So how do you sort of tie that up? And maybe Dan has some more insights there. I do sort of feel like if you're active in your SAA, there's lots of value that can be added there, because some of the framings that I might use, like yields as an indicator of bond returns, and PE ratios as a long-term indicator of equity market returns, they're sort of things that I'm be careful of the biases here, but I do have a little bit of anchoring on. I think they do provide useful foundations. As I get shorter time frames, I can't find much to anchor on. But Dan's a practitioner in this space.
Yeah. So, look, I'll have to divulge some of the stuff we do. We, when it comes to modelling and it comes to forecasting, we do it over 3 different time horizons. We look at the short term, 0 to 12 months out, the medium term, and the longer term, out to 10 years. And you're right, in the short term, it's very difficult to find things that can necessarily be particularly useful. So, we've done a series of tests and have found some substantive evidence in regards to a few things that are prevalent, and some of them are known, such as things like short-term momentum, for instance. And things like mean reversion over a 12-month time horizon, well, generally that's not a particularly good component, but over the medium term, that makes a very big difference, and frequently can have a great it can have an inordinate influence on the distribution of the results that you get with that when that reversion actually occurs. So in the short term, we actually combine some quantitative components, like I mentioned, momentum, along with qualitative elements where we use common leading economic indicators. We take each individual has their own individual views that they then put forward based on that information that they've got available to them. They started out as equal weighted kind of amounts that are weighted towards it. And then those that have shown that they have maybe more efficacy in one area than another might get a slightly higher weight in their input. But the short-term component is always ever only going to be a shorter-term element to what we do in terms of return forecasting. It's in the risk forecasting that I think that we can do a lot more in terms of short-term. And, without divulging too much and getting into too much technical detail about higher orders and moments and return distributions and the anchoring of valuation and stochastic volatility, there are tools and methodologies that can be used to manage risk in the shorter term while still having that medium to longer term investment horizon and sticking to that as your philosophy.
Yeah, the philosophy is the word that probably sums all this up, isn't it? Because consumers or clients, in a way, we just talked about a lot of information around SAA, from TAA to dynamic to risk defined. We've got all these different terms that we use and almost struggle, as advisors and planners to get all our heads around them in the first place, and then have clients to expect to understand that information. And so, yeah, certainly there is a lot of different translations to simplify things on the way through.
Couldn't agree more. In fact, we've tried to build solutions with names that it's pretty easy. They're self-explanatory. Things like risk defined. Well, why is it called risk defined? Because they're defined by risk. Why do you call that a lifestyle preservation portfolio? Because it's designed to preserve your lifestyle. Why is that a wealth creation portfolio? Because it's designed to create wealth. Why is that an aspirational portfolio? Well, that's for aspirational goals long term. Whereas, you fill out a risk profile, and you were talking about people with their cars earlier. A colleague of mine mentioned that he thought the names, conservative and balanced, they mean little. He knew of someone who sat down and filled out a risk profile questionnaire, and at the end of it said they were conservative. And he went, conservative? I drive a Porsche 911. How am I conservative? So trying to use non-jargony stuff that doesn't mean anything and make it a little bit simpler. But by adding to it, maybe we've made it simpler, but maybe we've just added more noise. I don't know. We're just trying our best.
So there you go. Maybe you should, there's a challenge then, to name your portfolios after different types of car. So we probably, that sort of circles back around to the beginning of maybe why modern portfolio has been so successful for so long. It was fairly easy to understand?
Yeah, I think, if I've sort of tried to describe some behavioural biases of the advice industry as a whole, it would be a simplification bias. And you can sort of, there's probably two reasons why it may have occurred. One, to create communication simplicity, and the other probably to create business model simplicity. And hopefully it's the former dominating the latter. But I think, best advice practices would be advancing your processes to deliver better client outcomes, but really improving your communication and framing techniques to clients. And if you can bring those on the journey together, then the quality of advice can only get better and better.
Yes. So what you're saying there to me is an advisor's, their philosophy and their bid that, whether it be the advisor or the planner, whether it be the business philosophy on what they're doing. And as we said before, around communication and around technology, around embracing that and be able to put as much information and content, whether it be videos or blogs or podcasts or whatever, about that as a thing that your business does, and a belief that you're, and a bias that you have, and the way that you do things, for then consumers to be able to listen to that and go, yes, that's the type of person I want managing my money. Your thoughts, Dan?
Yeah, I couldn't agree more. When we first started our business, I said, guys, 50% of our job is to run clients' money. The other 50% is to communicate with them and tell them what we're doing, why we're doing, and how we're doing it. It is just as important as actually managing the money, because if they don't understand, David's ambiguity. What did you say? Strong ambiguous bias. Yeah, ambiguity aversion. And it's true. Advisors and clients shouldn't be putting money into things that they don't understand well, and they're not going to understand them well without the education piece. And as you've mentioned, Fraser, there's been some phenomenal technological advancements that and tools that have been made available to advisors now that they didn't have 15 years ago. That the embracement of just makes this idea of communications and who people want to work with and why they would want to work with them so much easier for the consumer to make that decision, but also so much easier for the practice to be able to deliver. And I firmly believe it is the role of the people providing product solutions such as ourselves is to aid in that process, is to help with that process, is to provide these, whether they're solutions or it's content or it's information, that's not just to go and sell your stuff and sell your idea. It's to help educate, because you're in a position that you may have vastly more information and evidence to be able to provide that, an advisor, their world is just so huge. They have such a massive gamut that they need to cover. Helping them out, that's the least you can do.
Yeah, I agree. I think that's definitely a massive call to action for advisors and planners listening to this series in the idea of understanding what your philosophy is, being able to communicate it, being able to educate your clients on it, bring them along and understand their beliefs and biases and how they fit with yours. Gentlemen, we might wrap that up. Any final thoughts before we go?
If I had to come up with one word, I've banned myself from big words, it would be revisiting. So the ability to engage and revisit with your client and account for new information, account for new market updates, the interaction of goals and with the investment outlook, and that's going to keep reinvesting in the quality of the relationship and the quality of the outcome that the client receives. So hopefully revisiting, there's multiple revisiting points all through that process.
Yep, the evolution. Dan?
I hope that we haven't just provided the listener with problems, but that they've picked up on that there are solutions out there, that if they agree with these sorts of philosophies, there are tools, there are providers, there are things that they can do to implement in their practice if they feel it's appropriate to be able to provide a better solution to their consumer. And as David has just pointed out, that ongoing relationship with the client can be stronger and stronger and stronger by taking this sort of approach as opposed to treating things just as a compliance exercise. I think there's a huge value add that can be made there, not just to the consumer, but also to the advisor's business itself.
Yes, absolutely. Lean into the opportunity. And of course, we give our listeners the opportunity to continue the conversation. Probably we'll start with you, Dave. What's the best way if somebody wants to continue this conversation that they can reach out to you?
Well, thanks for the opportunity, Fraser. We're contactable. David Bell at the Connexus Institute, or David.Bell at the connexusinstitute.org.au. So we're independent, philanthropically funded institute. There's already a lot of open source materials on our website that the advice world's welcome to pull down. They probably have been targeted a little bit more the institutional world, but they're there. There's learnings there, and all these things can be adjusted and framed up the right way.
Yeah, wonderful. We love great resources. Dan, what's the best way that people can reach out to you or your team?
The easiest place is to go to the Innova website, INNOVAAM, so Innova Asset Management. .com.au. Again, we have a plethora of quarterlies and monthly articles and information available there, as well as a phone number, contact list, and on the XY forum, one of the members of my team is if somebody reaches out, we'll be happy to engage and get back to them. And whether it's me or it's somebody who's more appropriate than me to speak to them, we're more than happy to speak to people about things.
Fantastic. And I do know about a little tool that you have too for helping advisors calculate goals.
Yes, we do. We have built a calculator to help, and we've got some exceptionally good feedback on that. helps clients understand and recognize and look at what things can look like into the future in this. And we'll go back to the big word stochastic framework, where there is variability in the outcomes, and so therefore there is probability associated with achieving them. But it doesn't need to be thought of as that complex. It's more about, if you invest this way, if you leave all your money in cash when you've only got $400,000 and you're 65, you're going to run out of money by the time you're between 67 and 69. But if we can invest it slightly differently, it might run out by the time you're 66, but there's like a 90% chance it'll last well beyond your 80s. Which works better for you? I think those are pretty valuable conversations to have with clients, and they're far simpler than some of the other ones that go on.
Yeah, that's exactly right. It's always good to have tools that can have shout outs that make clients understand the ramifications of their actions. Gentlemen, thank you so much for joining us on this series. It's been an absolute pleasure.
Very enjoyable. Thank you.
Thank you, guys.